Do you know the top tax strategy for real estate investors to save five and sometimes even six figures in taxes? It's called real estate professional status. And there's a lot of misinformation out there about how real estate professional status works. So, in this video, I'm going to break it all down. I'm going to teach you how it actually works, and hopefully, you'll learn a thing or two. So, first, why should you even care about real estate professional status? Well, when you buy rental real estate, rentals can often produce positive cash flow, but for tax purposes, a tax loss. And the reason that that happens is because of something called depreciation, which is meant to track the deterioration of the components inside of your property over time. So it's true that real estate appreciates in value, generally speaking, but it's also true that the components that make up the property literally fall apart, right? The roof falls apart, the windows fall apart, the carpet falls apart, the appliances fall apart. And depreciation is an annual expense that landlords get to claim, meant to track that deterioration of those components. Depreciation is calculated by taking the purchase price of the property less the cost of land and then dividing it by 27 and a half years for residential property, 39 years for commercial property. So, for example, let's say that you buy a $300,000 single family home, $50,000 is allocated to the cost of land, leaving a remaining $250,000 to be depreciated. $250,000 divided by 27 and a half years is right around $9,000 in annual depreciation expense that the landlord gets to claim to offset the rental income from that rental every single year. You can also accelerate depreciation expense through cost segregation studies, bonus depreciation. So you can really boost what you can claim in terms of depreciation. And the more that you're able to boost depreciation, the larger tax loss that you're ultimately going to show. Because let's say that your $300,000 property cash flows $5,000 a year, but then you have this depreciation expense that it's not a cash flow factor, right? The depreciation is coming after we're taking our revenue minus our expenses, our operating expenses. So then when we tack depreciation on, even though we've got $5,000 of cash flow, we're going to be telling the IRS we actually lost money on this property. Which brings me back to why you should care. When a rental produces a tax loss, even if we're producing positive cash flow, we could have a tax loss. The problem is that tax loss is by default passive, and passive losses can only offset passive income. And your W-2 income and your business income is non-passive income, right? We often hear that being called active income. But other types of non-passive income are going to be capital gain from stock sales, interest income, dividend income. I know that all sounds like that should be passive, but the way that it works under Section 469 of the Internal Revenue Code, which details all of this stuff, all that type of income is non-passive. So the only type of income that's passive income is going to be income or losses from rental real estate and income or losses from any trade or business that you do not materially participate in. So landlords buy a bunch of rentals, they scale them out, right? Let's say we buy 10 of those $300,000 rentals, and now we have $50,000 of cash flow, but we have $40,000 of tax losses. What happens to those tax losses? We don't just want them to be passive and suspended and carried forward because there's no income to offset. We want to use those tax losses to offset our W-2 income and our business income. That way we can get the benefit today, which would be using the tax losses to offset our active income and receive a tax refund. So we want to reduce our taxes more often than not. And that's where qualifying as a real estate professional comes into play, because if you can qualify as a real estate professional, your losses from your rental activities will be considered non-passive and can offset your regular income, your W-2 income and your business income. So let's talk about how you qualify as a real estate professional. You have to meet two tests: spend 750 hours in real property trades or businesses and spend more time in real property trades or businesses than you do anywhere else. That second test eliminates everybody with a full-time job. Many investors don't like to hear that, and many investors have tried to prove the IRS that they can work a full-time job and also spend an additional 2,001 or 2,200 hours in real estate. The problem is the IRS has never bought it, and the tax court has never bought it. Many people have tried, and every single one has lost in tax court. So if you have a full-time job, you cannot qualify as a real estate professional because you cannot prove that you have spent more time in real estate than you did at your full-time job. If you have a part-time job, a little bit different, right? Or if you have a spouse that stays at home, they can qualify as a real estate professional even though you have a full-time job. but you have to outwork whatever other activities you have. Your real estate activities must exceed those other activities. That's the key to that second test. Now, you notice that both of those tests refer to something called real property trades or businesses. So 750 hours and more time in real property trades or businesses, right? So what are real property trades or businesses? There are 11 of them. Real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokerage. So the cool thing here is that you can work in one real property trader business and hit the 750-hour test and more time in real estate than anywhere else, or you can work in all of the real property trader businesses or a mixture of them. So you could be a real estate agent for 400 hours, a property manager for 300 hours, and then manage your own rental for 100 hours. And you have 800 total hours in real property trades or businesses. And if that's all that you do, you are a real estate professional. So the key here is that you look across all your real property trades or businesses that you are participating in, add up all the time together. Do you hit the 750-hour test? Do you hit more time in real estate than anywhere else? But the trap that a lot of people fall into here is forgetting to materially participate in their rental activities. So just because you're a real estate professional does not mean that your rentals are automatically non-passive. We're not getting that really nice tax treatment that everybody's attracted to. So you can be a real estate professional, but your rentals could still be passive. Those losses would still be trapped, still be suspended and carried forward. You have to show that not only are you a real estate professional, but you also materially participated in your rental activities. And there are 7 tests to material participation. You only have to meet one of them. The 3 most common that we see at our firm are spending 500 hours managing the rental, spending 100 hours and more than anyone else, or substantially all the participation in the rental is your participation, meaning that you self-managed, nobody else did anything, top to bottom, you handled everything. Property management, repairs, maintenance, tenant calls, everything. That was you. All right. So those are the 3 tests for material participation. Now, here's where it kind of comes into play. So let's say that you are a real estate agent and you spend 1,500 hours a year being a real estate agent, and that is all you do. You are a real estate professional because you meet the 750-hour test and you spend more time being a real estate agent than you do anywhere else or any other activity. The problem, though, is if you have rentals and you don't participate in those rentals, you have property management or they're super passive, then those rentals are still passive, right? Even though you are a real estate agent and even though you qualify as a real estate professional, your rentals are still passive. So you have to qualify as a real estate professional. You have to be that real estate agent, qualify as a real estate pro. And then you also have to make sure that you do participate in the management of your rentals so that you can hit those material participation tests. Okay, so now we kind of understand the tests to qualify as a real estate professional and how material participation layers in there. So if you do these 2 things, your rental losses will no longer be considered passive. They will move to the non-passive classification and be able to offset your W-2 income and your business income. But one question we have to answer is, how do we document all of this? Because after all, real estate professional status is highly litigated. We've helped many clients defend themselves in IRS audits with real estate professional status. So how do you protect yourself? And the answer is a really detailed time log. And this is the thing that nobody wants to do, right? So when you're going for real estate professional status, you also kind of have to think about, is the administrative headache of executing this worth my time, right? So is it worth the savings that I'm going to get? Because I'm going to have to not only spend time actually managing my rentals, but I'm also going to have to spend time documenting everything, and it has to be detailed. So to document this properly, you need a time log that shows the date and the time that you spent on the specific property. So list the property, show the date, show how much time you spent. And then you also need notes, and the notes need to be detailed. It needs to say exactly what you did. And you're writing for yourself 3 years from now, because that's typically when you're going to get pulled for an audit, right? If I'm working on the rental today in 2024, July 2024, then I might need to write notes in a way that reminds my 2027 self what I did in July 2024. So be detailed, link to receipts, link to trips, try to organize your life. If you're not a detailed person, this is where you need to either get a VA or you need to marry a detailed person. You need to do something that helps you stay organized, because missing these details is the number one thing that blows people up in an audit, based on our experience representing real estate investors in front of the IRS. Because this is the first thing that the IRS is going to ask you about when they are auditing your returns, and they want to audit your Schedule E, and they see real estate professional status there. They are going to say, send us your time log. And you want to be able to turn something around relatively quickly. You want to be really detailed so that they're not looking at it and going, oh, you only built this time log retroactively once the audit started. Because what the IRS auditor is trying to do is assess your level of credibility. How credible is the information that you're providing the auditor? And if the more detailed, the more credibility points that you're going to earn for yourself. Okay, I'm going to get off my soapbox about the time log itself, but now let's talk briefly about what type of hours you should be recording and you should not be recording, because this is where a lot of the misinformation comes into play. The reality is that real estate investors want it to be really easy to qualify for real estate professional status. So how do you make it really easy? Well, you record your education time and the time that you spend on the MLS and realtor.com and Zillow, right? All of that time is super simple. I can sit in the comfort of my home on my couch watching Netflix while also scrolling and researching and educating and listening to this video and a podcast and going to conferences and stuff like that, right? Like, that is all super easy stuff, and none of that time counts. I call that time junk hours. So the litmus test for the hours that will actually count for real estate professional status and for material participation are personal services performed to your rentals to make them go. So if your hours that you're logging are not helping your rentals collect more rents or pay more bills, then the hours do not count. And the hours that do not count are typically going to be education and research time. The tax court has consistently thrown out education and research time. Now, education might have a little asterisk next to it, in the sense that you are a real estate agent and you need continuing education hours or professional education hours in order to maintain your licensure. That is when education hours are going to count. But going on a cruise, spending 100 hours listening to podcasts or going to a conference, none of that time is going to count. And there have been specific tax court cases that throw out seminars and stuff like that. So be very, very careful who you take advice from related to the hours that count and don't count. So education research hours don't count. Investor level hours are not going to count unless you're involved in the day-to-day management of the activity. Investor level hours are like bookkeeping, paying bills, doing the tax return, anything that an investor would do to make sure that their investment is performing. That is investor level time. Due diligence, talking to my title company, my attorneys, my mortgage broker. None of that time is going to be counting unless you manage the day-to-day of the rental. So if you're buying a rental, you're doing all this due diligence, and then you hand it over to property manager after you purchase it, none of that time counts. But if you are going to self-manage it and not hand it over to a property manager, all of a sudden, a lot of that time can count, because even though it's investor level time, because you are managing the day-to-day of the rental, that time starts to count for you. So we hit education and research, we hit investor hours. The last bucket of time we have to talk about is travel time. Travel time is generally not going to count for real estate professional status or for material participation, because again, it's not making your property go. The exception to this rule is if you have a lot of local rentals. There's a tax court case called Lay versus Commissioner. That's the only tax court case that I'm aware of where the investor was able to count travel time towards real estate professional status and material participation. But the facts in that case were the taxpayer had local rentals to them, and they were visiting them on a pretty consistent basis, multiple times a week. And so in that case, if you think about the litmus test, if they didn't do the travel, then the rentals would have fallen apart, because they were self-managing, they were running them, they had to visit them on a consistent basis. But if you have an Airbnb that's 2 hours away, or a rental property that's 2 hours away, or a portfolio in another state, and you're visiting it a few times a year, the travel time is not going to count for real estate professional status. It's not, whether or not you travel will probably not impact your portfolio's performance. You might be able to argue that, well, if I don't travel, then I can't see it, and I might be missing a couple percentage points on gross revenue or margin or whatever. But the reality is that the tax court's not going to look at it that way, and the IRS is not going to look at it that way. They're going to say, hey, you have a property manager, or you're able to manage this at a distance. You don't need to actually travel. You're just doing that to log hours for real estate professional status. Now, the caveat here is that you can have a legitimate business trip, but it still doesn't count for real estate professional status. So you could have a business trip that you can write the expenses off of under section 162 of the Internal Revenue Code, but it still doesn't mean that it qualifies as real estate professional status time. So that's kind of the nuance there that confuses people from time to time. In the future, I'll put out some more videos on the time that counts and doesn't count. So make sure you subscribe to the channel, because this is an area where people lose IRS audits all the time. They record these junk hours. The auditors know that they're junk hours. There's a whole passive activity audit technique guide that the auditors are given, and they go through it, and it spells out these types of hours aren't going to count. So when you get a time log, disallow that stuff. So they're looking for it, right? You're not going to be able to fluff your hours and your time log to qualify for real estate professional status. If you get audited, you're toast. So it's really important to understand what counts and what doesn't count, and to do this as legitimately as possible. Because if you can qualify for real estate professional status and materially participate in your rentals, you have reached the apex of tax planning. It is amazing. The tax world opens up to you, and you will be able to capture so much in terms of tax savings that it's really important to get this right. But in future videos, I'll talk about real estate professional status strategies, such as how do you get your spouse to qualify? What do you do if you work a full-time job? We'll go through more of the nuances. I'll also be recording a video on the short-term rental loophole, because I know that that is being widely talked about, and there's a lot of misinformation there as well. But thanks so much for watching. Have a good day.